But our next guest says if history is any guide, we should be aware of the index at these levels. And in fact, joining us now to talk more about it is Tom Lydon. He's president of Global Trends Investments and editor of the ETF Trends.com. And still with us, of course, is John Sylvia as well. So, Tom, let's go ahead and start with you. When we talk about the S&P 500 at these levels, what is it that's concerning you right now?
Well, it's really not concerning. The big thing is we've had such a move since those October lows, as you mentioned. And compared to last year, all the volatility that we had in the market, it seems that volatility has abated. It seems that investor confidence has really come on strong. However, corrections do happen, and what we always look at in trends is that 200-day average. So far, it's been nicely above the 200-day average this year, and as long as we remain above that average, we should be in great shape. But historically, 1400, as you look at the past decade, is really kind of a tipping point for the S&P.
Okay, so what's the catalyst then for a correction? Because the way it seems right now, the markets just want to continue to move higher.
Well, they do, and that's key and critical. We've had better than expected earnings. We've got better investor confidence, consumer confidence. That's all great. But kind of the wild card are inflation, oil problems potentially in Iran as far as shipping, and also what's going on over in Europe regarding the Greek debt crisis. So here in the States, we're watching very closely. However, a lot of money, $1 trillion, has shifted out of equities into bonds in the last couple of years. And as long as that remains confident on the fixed income side, great. But the big concern, I think, here in the U.S. is investors are underinvested. So we may see, while there's low volatility, actually a fear about being out of the market. We could potentially see a market melt up as we head into the summer.
Tom, this is John Sylvia at Wells Fargo in London right now. And Jackie had a story earlier about the Republican budget plan. Martin Feldstein had an article in the Financial Times this morning about fiscal policy. Towards the second half of this year, where do you think the equity investor will assess the fiscal plans coming through? And again, Martin Feldstein's argument that the beginning of 2013 could see a significant restrictive fiscal policy put in place.
Well, I think that's absolutely right. But when we bring it down to the lowest common denominator as far as the average investor, they're asking themselves, are they feeling better about their current situation? And most are today. They're feeling more secure about their jobs. They're feeling more secure about income. And as we get into the elections in the fall, that's what many are going to be asking themselves. So again, the fear trade to some degree is off as people have shifted out of equities and back into fixed income. I think the biggest thing going forward is when we see yields start to rise, as we've seen in the 20-year Treasury, a 10% decline in that 20-year Treasury, most people don't understand what that's going to do to their fixed income portfolios. So there's a strong case as we go into 2013 for higher equity prices for sure.
Yeah, Tom, but what was also prominent in yesterday's session in the United States was that bond yields, Treasury yields backed up, and we also saw the dollar decline as well, but equity markets moved up. Is this sort of a new trend, or is something that, how is the dollar direction really going to impact equities?
Well, you know, the big thing is inflation. Right now, people are feeling a little bit more comfortable about the markets, but we're starting to see higher prices at the pump, higher prices at the supermarkets, and that's the big concern, I think, as we go into the summer. Here in the U.S., a lot of folks in the last couple of years have cut back. There's been less travel in the summertime. They haven't taken vacations. They've been spending less. The big, I think, litmus test will be, as we get into the summer, are people more confident? Are they starting to spend more? And is inflation starting to creep in its ugly head? That, I think, is what many investors are looking at as we get into the summer.
Yeah, all very good questions, Tom. Thank you so much for your insight. Of course, Tom is going to stay with us to provide some more of his opinions coming up, as well as John Sylvia, our guest host for the rest of the hour. And looking ahead to the day on Wall Street, joining us now is Tom Lydon, president of Global Trends Investments and editor of ETF Trends.com, as well as John Sylvia. Tom, let's go ahead and start with you. When we look to the housing numbers, obviously housing market is going to be a huge part of the recovery, at least here in the United States. What are your expectations?
Yeah, absolutely. Well, we've seen, 4.5-year highs in housing production, which is great. When we're looking here at the U.S., it's inflation, it's housing, it's the markets, and overall that's affecting consumer confidence in a very positive way. So the numbers will be very interesting, but still we've got a major glut as far as houses here in the U.S., and working through the foreclosure situation is something that Americans are very sensitive about today.
Absolutely. We talked about this briefly a little bit before. Some of the headwinds that President Obama is going to face in this election obviously include the higher gas prices. It includes the housing market, also still includes the unemployment rate unless we see a substantial decrease. How do you feel those issues are going to impact him as he tries to get a second term in the White House?
Well, absolutely. The unemployment numbers seem much improved in the last couple of months, are very, very positive. Also, from a housing standpoint, it's important to note, regionally, we've seen some improvements. I mean, we're here in Southern California. We weren't hit as hard as some areas of the country, and we've seen a lot of traction. So that's very positive. Areas like Arizona, Las Vegas, Florida, especially Michigan areas, still, it may take a while or even years before they get out of the slump. So in some instances, from a housing standpoint, here in the U.S., it may be more of a regional issue.
A quick final thought for you, John, about the housing market. It's crucial that there is a final line drawn under the housing market slump to really have a convincing recovery in the U.S., right?
Yeah, I think I do think we have a recovery. We're looking for something like 700,000 this morning. And I think the regional disparities that Tom was talking about is absolutely key to understanding the housing market in the United States.
Yeah, Tom, I want to bring it back to you. I mean, let's talk a little bit globally here. How do we manage what we're seeing in terms of the markets and the rise, the sort of daily rises that we've been seeing, some of the volatility there? How would you be investing in this? What would you be doing specifically?
Well, that's a great question. The average investor here in the U.S. and most investors participate via their 401ks are underallocated globally. And when you look at some of the GDP growth, especially in emerging market countries, there's great opportunity. So with 60% of global market cap being outside the U.S., it's really important to be diversified. And when we have that GDP headwind and also great market strength, especially off the October lows, it'd be important to participate in those
we are
areas.
running out of time. We are going to have to leave it there. Thank you so much for joining us, to Tom Lydon and also John Sylvia as